Welcome to the Heroic Investing Show. As first responders, we risk our lives every day. Our financial security is under attack. Our pensions are in a state of emergency. A single on-duty incident can alter or erase our earning potential instantly and forever. We are the heroes of society. We are self-reliant and we need to take care of our own financial future. The Heroic Investing Show is our toolkit of business and investing tactics on our mission to financial freedom.
Hello and welcome to episode 135 of the Heroic Investing Show. This is a podcast for first responders, veterans, active duty members of the military, retired firefighters, police officers, and really anyone who's looking to improve their financial future and gain some freedom with their time. We teach America's heroes how to build passive income, build their startup business, and safely grow wealth through real estate and other alternative investments. We help current and prior first responders put protections and systems in place to enable them to build a life where they can focus on their passion, that service or product that they are uniquely gifted to share with the world. My name is Gary Pinkerton, and I am humbled and extremely proud to co-host this show, the Heroic Investing Show, for all of you. On episode 135, Jason has a discussion with Ken McElroy. And those of you, I'm sure, who are interested in real estate are familiar with Ken McElroy. He's someone that I consider a mentor, somebody that I've been around and spoken to and learned a tremendous amount from over many years now. He's a real estate advisor for Robert and Kim Kiyosaki. He runs their multifamily real estate portfolio. He's a successful real estate syndicator, has been doing that for many decades. But his largest success is what he did to raise investor capital and purchase rental properties, large apartment buildings, and add value and refinance out investor capital and repeat the process starting in 2008, 9, 10, and 11 when capital simply wasn't available. And so Ken and his partner went to Canada and raised a lot of investor money out of Canada to help purchase real estate when there was no appetite for large lenders in the United States to fund continued reinvestment into these properties. And so he single-handedly, or his company single-handedly, is responsible for improving living conditions for thousands of people and making a lot of investors very, very wealthy. So there's a tremendous amount we can learn from Ken. He and Jason on this episode, and actually we split it into two different parts. And so next Friday, you'll get part 2 of Jason and Ken McElroy, where they focus a little bit more on the ideas of home ownership and how to treat your property manager and your tenants. But on this one, they start off talking a little bit more about the impact of the tax bill and what changes are coming. Ken talks about the 2 common mistakes that he sees most real estate investors making. He talks about his real estate business model, the fact that real estate, this is a key point, that real estate is very cyclical. And so you can't just lock into, you can maybe lock into one niche, but you can't lock into one formula, right? So people who think that it's smart to buy in one town or one exact type of property because it's been successful for them for the past few years are eventually going to go the way of the dodo bird because markets change. There's a time to be a buyer. There's a time to refinance. There's a time to just rehab what you have. There's a time perhaps to partner with new construction. There's a time maybe to do conversions from residential over to commercial. Maybe there's a time to convert from commercial back to residential. Condo conversions are not the right solution in every market. For example, condo conversions are big at, a peak of a market. But at the low end, when we're just starting a large upswing in real estate, it typically means that there's high demand. And it's more important to be building large apartment buildings for people to rent than probably it is to be doing condo conversions. So you have to be fluid and be able to move with the economy as conditions change around America. And so I think Ken has been just an absolute incredible example of how to do that. I mean, he's been building self-storage in southern Texas on the Gulf to support activity down there because of fracking of oil and now the new oil exporting. Just an example of how you can change your model to support the needs out there in society. And in the end, an entrepreneur is someone who has the ability to be early to recognizing where there's a need in the economy and solving that need for people and getting compensated for it. Really, I mean, that's what an entrepreneur does. So he's really been pretty inspirational, really good about doing that. And then his other message, I thought in this one that was really good, comes near the end of this clip. And he's talking about how, and I've learned this in spades in my own small portfolio over the last decade, is that C-class properties look really, really good on paper, but they end up performing much lower than the pro forma, while A or B class don't look so good, but you end up with a better tenant and they start performing a little bit higher than the paper because they take much better care of your property and perhaps you've overestimated for what you're going to have in expenses and vacancies. So I think there's a lot of wisdom in this 2-part series. I'll be back to intro part 2 next Friday. And I really, really hope you all enjoyed our World War II veteran and hero, Marine Corps, Larry Claremont from Chicago. What an amazing guy. Hopefully that acoustics, it was very challenging when we first were recording, but hopefully the amazing Adam was able to do some incredible stuff with that in post-production and able to save a lot of that really, really good conversation. So thanks so much. I'll be back with you next Wednesday for some other original content. And then we're going to be back with part 2 with Ken McElroy on Friday.
Now, our guest today is Ken McElroy. We're probably, like we did with the last interview, we're probably going to go a little long, so we'll probably do this one in 2 parts. I got to play an important video for you. This is with Steve Leisman. He's a senior economics reporter with CNBC. You all probably know who he is. Listen to this. Listen to this. It's really quite amazing. Here we go.
Was here a quarter ago breathlessly talking about the rise in optimism. I don't know what the next step up is above breathlessly because we have done it again. We've surpassed the old hyperventilated. I don't want to hyperventilate, but folks, we have this surge in optimism and it appears to be helping at least a little bit the approval rating of President Trump. Take a look at the numbers here. For the first time in the history of the survey, and folks, we've been doing this for more than 10 years now, 51% of the public says the economy is good or excellent. We have not been at 51%. You could see it rose steadily under President Obama, but it absolutely surged under President Trump.
And then, by the way, this is the life of the survey.
This is the life of the survey that we're looking at, absolutely. Yeah. And then 41% of the public says that the economic outlook is good, or the economy will get better in the next year. You don't see it here. 50% of the public says it's a good time to invest. They're upbeat on the outlook for their wages. They're upbeat on the outlook for housing. And then take a look at the next set of screens, and we'll show you how this may be affecting the approval rating of President Trump. You can see that his approval rating went up by 4 points, and his negatives came down by 3 points. This is the approval rating, by the way, guys, is in line with a recent trend you can see in some polls. This 40% over above, getting rid of the 3 handle, getting the 4 handle.
But still having half the country disapproving, even with economic numbers like that.
But I think it's more than even. I think he's underperforming relative to the economy. But then take a look at the next screen, Beck, which is his economic approval ratings, and those are better.
Yeah.
He was already net positive in our poll, 43-41. Now he's positive 47-43, a little bit wider there, and you can see people approve of his economic handling of the economy, while less so the overall. And I want to just show you the trend here, which is the next screen, guys, is the net approval. We do approval minus disapproval. You can see he had a very bad summer, and then it's come back to where it was. He's -7, and on the economy, he's +4 right there. What you don't see, the question is, why is this happening? One thing we know for sure, Republicans have come back home. They've dug in. They had abandoned him a little bit. In other words, his numbers with Republicans were not as high as they should have been. They're back where they are. Independents, a touch more positive. Democrats, a touch more positive. But it doesn't seem to be the tax bill, because I'll tell you, the tax bill does not poll very well. Just 26% approval overall of the 800 Americans we polled nationwide. And it's even tepid among Republicans. Just 56% approval among Republicans.
Why do you think that is?
But hold on, let me just tell you the other side of that.
More.
There's a large don't know.
Okay.
There's a big 30% don't know in our poll.
Because we still don't know a lot of the final details. So
I think that's probably it. But I think what we're seeing here is the economy really helping out the president. And we'll see what the upside here, how far it can go. There are obviously other things that keep people from backing the president.
They say people vote with their feet in the stock market.
Right.
So I know it's global synchronous growth, but stock market's going up, has to do with the tax bill. So people voting with their feet to control the money are voting in favor. You'll never get a tax bill very high. And then as far as the approval rating for Trump, what do you think, Becky, the maximum approval rate? What do you think his solid negative number that will never change is? 45 minimum. 45 minutes. 45 impeach him. 45 would be impeach immediately.
I don't know. I don't think 45.
I do. I think 45 at least, just with the tweets and the
if you took I'd love to see if you took Twitter out of this.
No, well, or just in general.
We asked that question a while ago. People want him to stop tweeting.
You saw
that. Republicans want him to stop tweeting.
But it works for him.
So I hope you found that video interesting. We've got to get to our guest, Ken McElroy, but before we do, I want to remind you we are wrapping up the 5-year plan contest. Go to jasonhartman.com/contest, jasonhartman.com/contest, meet the masters. We got a new landing page. Make sure, if you're interested, you upgrade your tickets so you can enjoy dinner, an intimate dinner with Ron Paul, and you can meet him and get a photo op and get access to the green room and all of the rest of the good stuff at our upcoming Meet the Masters event in La Jolla. If you haven't registered, of course, you want to get your tickets for that ASAP. jasonhartman.com/masters for that. jasonhartman.com/masters. And remember, income property is the most historically proven asset class in the world. We're going to go to Ken McElroy. One thing during this interview with Ken McElroy, the Rich Dad Advisor, great guy, he talks about how I spoke at his conference last week. It was great. It was his annual employee retreat. I was honored to be one of the speakers there. And during my keynote speech, I talked about something called the Wheel of Life. This is something that I learned about from one of my early mentors at age 17 who changed my life. That was Dennis Waitley, along with Zig Ziglar, Jim Rohn, and Earl Nightingale, my 4 great mentors who really changed the course of my entire life. The Wheel of Life is about life balance. What some of the speakers that teach on this Wheel of Life concept, where you sort of rate on a 1 to 10 scale different areas and aspects of your life, they talk about making your wheel round so it will roll through life really well. And I agree with that. That's a good point. You know, there can be, as Stephen Covey, another great mentor of mine, talked about, the late Stephen Covey talked about, you can have seasonal imbalance. It's okay for things in your life to be imbalanced, just as long as they're not permanently imbalanced. You know, if you're engaged in a special project or a campaign or whatever it is, you know, you may be imbalanced for a while. Don't beat yourself up about it, but try to ultimately correct that where you have more balance, okay? But the other thing that speakers don't talk about when it comes to the Wheel of Life is they don't talk about the fact that your wheel should be large, okay? Because if you rate yourself, and we'll probably do an entire show on this, or I'll get the audio from Ken of my speech and I'll just play it on the podcast for you so all of you can hear it. But if you rate yourself a 1 in every category of life, well, your wheel will be round, okay? But it won't be very big. That won't be much of a big life, right? And I think the goal is to have a kind of a big life where you're doing a lot of things and engaging in life and having some adventures and a lot of satisfaction in every area of life. So hopefully you get a 10 in all areas, or an 8 or a 9, right? And you have a big wheel, but also a fairly even wheel. Because remember, a small wheel, like maybe the wheels on your luggage, or hey, your skateboard, if you skateboard, right? Those get stuck in a rut very easily. The larger the wheel, the easier it can go over bumps in life and get through ruts in life, right? If the wheel is small, it's going to get stuck. So I just want to share that one little example. But let's get to Ken McElroy, and we will have part 2 of this interview tomorrow on the next episode. So this week, hey, we're doing 5 episodes this week. I hope you're excited. Anyway, here's Ken McElroy, Rich Dad Advisor. It's my pleasure to welcome back a returning guest, and that is my friend Ken McElroy. He is the epitome of the word entrepreneur. For over 2 decades, he has experienced massive success in the real estate world, from investment analysis and property management to acquisitions and property development. With over $700 million investment dollars in real estate, Ken offers a unique perspective on how to get the biggest return on investments. He is also, of course, you know his name because he's been on the show before, but he's the author of the best-selling books in the Rich Dad Advisor series, the ABCs of Real Estate Investing, the Advanced Guide to Real Estate Investing, the ABCs of Property Management. His newest book on entrepreneurship is The Sleeping Giant. He's an advisor to Robert Kiyosaki of the Rich Dad Company, and they have co-authored several audio programs, including how to increase the income for your real estate investments, and how to get your banker to say yes, how to find and keep good tenants. He's a chapter contributor to the newly released The Real Book of Real Estate. Hey, Ken, welcome back. How are you?
Great, Jason. Great. Appreciate being on the show again. I always appreciate the opportunity.
It's good to have you back, and it was great to see you last week. Thank you for having me as a speaker at your annual corporate retreat. What a great group of people you have. I just thoroughly enjoyed myself, and I think they enjoyed my presentation too, I hope. So
they did. Yeah, you did a great job. That wheel of life, it hit everybody. I got lots of comments and people loved it. So thank you very, very much. We try to educate our folks through personal development, and it seems to be paying off. We have a very, very low turnover rate in our company.
Yeah, that's fantastic. Just to give a little overview of your company, how many employees do you have? You kind of have 2 sort of concentric circles of employees, the way I would look at it. You have like your corporate people in your corporate office there in Scottsdale, and I've been to your office before. And then you have your big circle, which is all the different people on site at leasing offices, maintenance people, property management people. How many are there? It seemed like there were probably, 130 people, I'm guessing, at the event.
Yeah. So what we did is we flew in managers and maintenance supervisors from all our properties. So we have almost 10,000 units. We like to have them here in Scottsdale once a year, and we study a book together. But all in all, I think we have just under 300 employees altogether,
wow,
including corporate office.
Wow. That's amazing. That's a lot of employees to manage. And gosh, 10,000 units. Ken, I think you're upping my own personal goal now. I'm green with envy over here. That's awesome.
Yeah, I think it's as you know, it's a overnight success.
Yeah, you're a 20-year overnight success.
Yeah, exactly right.
Yeah, exactly. Good stuff. Well, hey, Ken, I want to talk about a few things with you, as I mentioned in the intro. We're going to talk about the economy in general. Maybe we'll talk about the homeownership rates and some best practices in property management, because as any legitimate real estate investor knows, it lives or dies on property management. You can watch the late night infomercials, you can read the books, go to the hypey seminars and the pitch fest. But at the end of the day, this is kind of a mundane business. It's just to do the right thing every day, and you're going to make a ton of money because it's the most historically proven asset class in the world. But you got to be willing to set up the right practices and the right thing. So, maybe since I kind of teed that one up more, maybe we'll start with that. I don't know. Where do you want to start?
I think it's a good start. I think a lot of times, Jason, there's 2 things that I see as 2 common mistakes that I see. The first one is people get caught up in the hype of flipping, And as you know, there's a time and a place for that if you're going to do it, but you do pay a lot of tax, and then you got to buy something again. So finding a good real estate deal typically for me has been the hardest thing. So I like to keep them. I like to cash flow them. And so I think when people think of real estate, they think of, timing a market, buy low, sell high, kind of like a stock. So I think that's a common mistake, and that's completely different than what I do. As you know, we don't sell hardly anything.
Right. And Ken, let me just, before you go on, let me make a comment on that. I have definitely noticed over my decades in this business that the people who flip and who, do the fix and flip type model, they have spending money. But the people who buy and hold, they have real wealth. And, at the end of the day, I'd rather have real wealth than spending money. I mean, spending money's okay. I'll take it. But, you pay so much to the government when you flip these properties. And it's just like the good, sustainable sort of value investing philosophy that is yours and mine and Warren Buffett's, if you want to use a stock metaphor, is to just buy it and hold it. I completely agree with you.
It is, yeah. And then, and I'm speaking from experience, because one of the things that I did in my career, since going back 15 years, is I did condos. I did condo deals and condo conversions and condo projects, and a whole lot of effort to sell thousands of condos, over like a 4 or 5 year period. We were very successful. Our company made a lot of money. We had a great organization. But once we were done, we didn't have any real estate left. We'd all made a bunch of money, and, the company shrank down again because there's no revenue coming in because all the condos were sold. And so you're always having to go out and buy things to keep things going. And unfortunately, or fortunately, real estate's cyclical. So you can't buy throughout your career. There has to be a time when you have to step back and then come back in and then, buy and then step back.
Comment on that. I have never met anybody who can really reliably predict the cycles. I mean, you can take some good educated guesses, but it's just hard to know. I mean, you just value invest and you can just buy things that make sense and hang on to them. It's pretty simple.
It's surprisingly simple. And so I just, Jason, as you know, that was a big lesson for me, because 15 years ago, I had cash, I had nice things, but I did not have wealth. And so the next time, that was in 2001, I decided that my next run was going to be a buy, hold, cash flow model. And that's what I've done. And so now we're actually close to $1 billion now in assets. And it's been all through buying properties well, making sure they cash flow, and then returning that cash flow to the investor. So, we had to dig deep and syndicate and go after, money to, raise capital to buy things. But it's a much better model. And I will tell you, we will have a correction. Occupancy rates will go down. There will be concessions, and there will be less cash flow. You're going to experience that. And so when you have well-positioned assets that are not too highly leveraged, that are cash flowing massively, then you're going to last through those times just fine,
Yeah, I agree. And if you're not investing in the very, very cyclical markets also, you don't invest in those. You're pretty much in the hybrid markets as far as I can tell, that used to be linear. So, these are not like the high-flying markets. I mean, you're not buying stuff in Manhattan, New York, right? Or, Miami and these super expensive high-rises, or in Los Angeles or San Francisco. You're doing more prudent stuff than that, aren't you?
Yeah, we are. So our model has been kind of what we call, the workforce. So we want really nice, well-maintained properties. And when I say that, I mean they're gated, they have clubhouses, some of them have concierge, some of them have gyms, some of them have indoor pools. So these are nice properties that we bought that might be 20 years old, that, needed a few $1 million. And of course, we're building too. So we're building brand new. But to your point, we're building in markets like Phoenix and Scottsdale and, Plano, Texas, or Carrollton or Dallas, some of these markets that really have great people, great jobs, but really people do have choices in those markets too. And do they want to rent or do they buy a home? So there are strategies on where you want to buy rentals in those markets, unlike San Francisco or Chicago or Seattle or New York, where you just don't have that kind of a down payment.
Yeah, no, I couldn't agree more. Those markets are just absolutely crazy. Okay, so talk to us about some best practices in property management. Just rattle off a few of them. Of course, you're speaking, and I'm super excited to have you speaking at our upcoming Meet the Masters of Income Property event. It's going to be awesome to have you speak. You were kind enough to come and speak to my Venture Alliance Mastermind, my small group once last year, but this will be the big one. So you'll be speaking to a much bigger audience this time, and we can't wait to have you. You'll have a chance to go into this in a little more depth, maybe in person, but just a couple of thoughts here on property management, how to do it right.
Yeah, I think there's a few things. One, I don't think that a lot of real estate investors engage the property management folks early enough. In other words, I think that they should be part of the process, part of the acquisition. I really do. I think that if you're not going to manage it yourself, you really need to get the individual involved, because what they'll do is they'll help you understand rents, they'll help you understand expenses, they'll help you understand markets, so all those kinds of things. Property management is very local business.
Oh yeah.
There's a few big mistakes that are made, and probably the biggest mistake is on who you let in, actually, obviously, because there's a whole series of mistakes.
Tenant screening is what you're addressing, right?
Yeah, and there's all kinds of ways to do that, but we run criminal credit background checks and sex offender checks on every one of our tenants. So we do about 400 or 500 a month on our properties, our portfolio. So it's so crucial that you have no idea. I can honestly tell you, Jason, I don't think that we evict very many people. You got to imagine we have 10,000 tenants.
Right.
And when you find somebody that they just want to rent, they're a good family, they've got good jobs, they are so good. They just want a nice, quiet, safe place to live. And the experience can be remarkable as compared to the opposite. I have a bunch of stories around that because we've made a bunch of mistakes, over the years. And that's why we've gotten to where we've gotten as far as our criteria to get in. And so when I see what happens, if there's vacancy and somebody has a stress point over money, maybe their mortgage is due and they go on to Craigslist, not that that's necessarily a bad spot, and they end up renting, and you start to see things like drug activity or, who knows what, they just don't pay, or, the damage. And, there's just a million stories that can come from putting that wrong tenant in there. And then it can be very expensive to get them out, depending on the state, as you know.
Yeah,
like,
it varies.
You used to live in California, and California's
that's a disaster. Yeah, that's the worst one ever. Well, New York's probably worse than the California, but they're both pretty terrible.
Yeah, it's tough. It's tough to get people out. So, you really want to – that's probably the biggest, single most problem. And then everything stems from there. Yeah. I mean, all your issues stem from that.
Okay, so let me back up one step from that even. And I think it's sort of in what you're saying and kind of what you said before, Ken, but you didn't actually say it. So I want to make sure the listeners hear it. We offer A, B, and C properties that people can buy through our network. And we offer the C stuff, but we really try not to sell it. It's kind of like your discount line, and it's just, those look great on paper, man. But in real life, I mean, they might do great in real life, okay? But, in the law of large numbers, when you look at the averages, right? I think you're just going to do better with better quality properties. That brings you a certain type of tenant profile. Now, granted, there are exceptions. You can have an A property with a D tenant, or a D or a C property with an A tenant. It's all individual. But in the law of large numbers, in the law of averages, it's going to work out that you're just going to have better experiences with better quality properties and better quality tenants I say. You agree with that?
I do. Yeah. And I've managed all those kinds of properties. I've managed personally over 30,000 apartments up and down the Western U.S. And there's several in Phoenix that we've, back when we were doing fee management, I remember two particular properties where, one was, it was so bad there was a police substation in our rental office. Another one, the cops literally would not, they had this, can't remember exactly what to call it, but they would not go in unless there were two. So in other words, if there was a call to that address.
Yeah, not a single cop will not go. It's too dangerous, right?
A single cop would not go. I remember walking in one of the units and there was an AK-47 leaned up next, on the side of the, right next to the front door. And so, birds of a feather flock together, man. There was gang activity, drug activity, and those are management issues. Don't get me wrong. The property next door on both sides was just fine. It's who you let in is big. And it's the craziest story in the one. There was literally a guy in a wheelchair. This is unbelievable to me, but he was a guy in a wheelchair. He was a drug dealer in a wheelchair.
All right.
So the cops were watching him. Guess how he got in a wheelchair?
How's that?
Got shot.
Yeah. Huh.
So here's a guy in a wheelchair dealing drugs, already been shot once. And he's, under surveillance. And so those are real things. And not everyone in that property is a drug dealer, but people that are living in those environments move out. Good people move out.
Yeah, right.
So you just really got to be careful on who you let in. And you're right about that. It's not always in a C property. I've seen A properties be that way. I've seen B properties be that way and C properties be that way. But most of the time they land in the C because they're lower rent, they're lower rent options on the outside of town somewhere.
Yeah, that's true. So I think that's an important thing. This will be continued on the next episode. Thank you for listening and happy investing. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.